Hey everyone, Teresa Guthrie here with Catch You on the Pip Side. Today I'm going to shoot a quick video just explaining risk management. So for risk management, it's important to decide how much you're willing to risk per trade. Every different strategy that you're going to look at with Forex or crypto trading might have a different amount that whoever you're learning from is teaching you how much to risk per trade. Generally speaking, for the strategy that I use, I risk 2% of my account max per trade. So 2% max risk. So depending on how big your account is, that's going to change how much you're risking in dollars. But the important thing to remember is that the percentage always stays the same. You don't want to, if you're like, oh, this trade's going to be awesome, I'm going to risk 5% on this trade, and be like, oh, I'm not so sure about this trade, I'm only going to risk 1%. You want the amount that you're risking per trade to be a consistent amount. So once I know that I'm going to risk 2% for every single trade, that's the amount that I use. So every morning when I wake up and I'm about to start trading for the day, I take a look at my trading account and I see what my current account balance is. So let's just say that you're trading with a $10,000 account. So you wake up in the morning, your account balance is $10,000. You're going to multiply that by 2%, which is going to give you $200. That's the most that you're willing to lose on a trade. Okay, that's the most that you could lose on a single trade. Now, once you know that number, every single trade that you take is going to have a different stop loss, generally speaking. I mean, you might have the odd trade that ends up having the exact same one, but for the most part, every trade has a different stop loss. So you need to know how many pips are in that stop loss so that you can calculate what lot size you're going to use. So the calculation that I use is that you're going to take the $200 that you're willing to risk per trade, and you're going to divide that by how many pips are in your stop loss. So let's say, just for example's sake, that you have 200 pips in your stop loss. So if we take $200 and divide it by 200, you're going to get $1 per pip that you're willing to risk. Now, it's very important to remember that if you are dividing a dollar amount by a number, the answer is going to be in dollars. This is not your lot size. This is the amount that you're willing to risk per pip. You have to then convert that to the closest equivalent lot size. So if you're willing to risk $1 per pip, the closest lot size in Forex to that is going to be 0.1, or what we call a mini lot. Now, this only holds true for US dollar pairs that have the US dollar in them. So let's just say USD CAD or USD NZD. Okay, any pair that has the US dollar in it. If it's a cross pair, like say AUD JPY, then 0.1 is not going to be worth exactly $1 per pip. It's going to vary depending on the currencies of that pair. That's where using a calculator, a position size calculator, comes in handy if you want your numbers to be very precise. This is going to give you an exact number for US dollar pairs, and it's going to give you a close enough number for most just like regular Forex cross pairs. I wouldn't use this for exotics, and you can't use it for, well, yeah, you can use it for cross pairs, but it's just not going to be exact. And I'm going to show you at the end of this video what calculator I use and how I use that to get a more accurate lot size. So let's just do another example here as a walkthrough. So let's say you have a smaller account. You have a $1,000 account. And again, you're only willing to risk 2% on a trade. So this time your max risk is $20 on this account. $20 max risk. You take that $20 and you're going to again divide it by how many pips are in your stop loss. So you're actually going to have to do the math on between your entry price and the stop loss, how many pips are there. So $20 divided by the pips in your stop loss. And for this example, let's just say that there's 634 pips in that stop loss. Well, when you take $20 and you divide it by 634, you get 3 cents. Okay, that's how much you're willing to risk per pip. And again, remember that this is a dollar figure. This is not your lot size. You now need to take that amount and convert it to the most equivalent lot size. Now, what you're going to find in this example here is that the smallest lot size is a micro, which is 0.01. Well, 0.01 is worth 10 cents per pip, and you're only wanting to risk 3 cents per pip. So what does that mean for you? It means you cannot take this trade if you only want to risk 2%. And again, back to what I said at the beginning, this isn't the time to just be like, oh, well, I'm going to risk 5% on this trade because I want to be able to take this trade. No, that's not the way it works. Your account is simply too small at this time to take this trade, so you just can't take this trade. If you were to play 0.01, which is worth 10 cents per pip, you would be over leveraging your account by like 3 times. You'd be risking 6% instead of 2%. Okay, so you can't do that. So you would just have to say no trade. Okay, and you just have to deal with that fear of missing out or FOMO and catch the next one if your account's not large enough, and just build your account up to the point that you can start taking these larger swing trades with a big stop loss. And this example that I gave here was quite exaggerated. This is a really large stop loss, which would be for a really large swing trade. But I just wanted to illustrate the point that there is sometimes that you just can't take a trade. So we'll do another example. So now let's just say that you have a $3,000 account times your 2% that you're willing to risk, or whatever number it is that you've decided that you're willing to risk per trade. So this is going to be $60 max risk per trade. We're going to take that $60 and we're going to divide it by how many pips are in our stop loss. So let's say this time we have a very small stop loss. So the pips in your stop loss, let's say this time it's 5. So you go $60 divided by 5 is $12 per pip that you're willing to risk. Every pip is worth $12. So in this case now, again, reminder, you do not use this as your lot size. You would be playing $120 per pip, not $12 per pip. So you need to find the closest equivalent lot size, which for $12 per pip, that's going to be 0.12. This would be equal to $12 per pip. Again, only true on US dollar pairs. Okay, if this was a Forex pair, Forex cross pair, sorry, then the numbers would be slightly different than this. So hopefully that makes sense. What I'm going to do here is I'm going to switch my screen over to show you the position size calculator that I use. I like to use the position size calculator on my FX book. There's lots of different ones that you could use. There's baby pips, there's Stinu. So there's a few different ones. This is just the one that I prefer. And the URL is myfxbook.com. And if you click on home, then it says Forex calculators, and you'll get a list of the different calculators they offer. And the one that we're using right now is the position size calculator. So on this position size calculator, if we do the same example that we just did, where we had a $3,000 account and we're willing to risk 2% on that trade, and we only have 5 pips in our stop loss, and we're trading Euro USD, you would press calculate. And you can see that the lot size here, so you're willing to risk $60, just like we said, and your lot size comes out to 1.2. Oh, hold. Did I make a mistake back here? Oh, yes, sorry, I did. Okay. 1 second. Sorry, $12 per pip. This would be, I can't even erase this. Hold on. Okay, sorry, I'm just going to type out that example because I made an error there. Okay, so you have a $3,000 account times 2%. You're willing to risk $60 on this trade. You take your $60 and you divide it by the pips in your stop loss, which in this case we used 5. And so you're willing to risk $12 per pip. The lot size equivalent to this is 1.2 because a standard lot is equal to $10 per pip and we want $12 per pip. So 1.2 would be worth $12 per pip. So if we go back to my example over here, you can see that when we did this, 3,000 times 2% with a 5 pip stop loss on Euro USD, keeping in mind that this is a USD pair, your lot size comes out to 1.2. Now, I want you to watch what happens if I change this to a non-US dollar pair, a non-major pair. If I make it, for example, AUD CAD, now your lot size is 1.52. The reason for that is that now we have to look at the price of the US dollar to the Canadian dollar, and it affects how much that pair is worth per pip. Okay, so AUD CAD is not worth $10 per pip on a standard lot. It's worth more. So that's why you get to play a larger lot size. And if we do this again and we switch it to a different cross pair, like let's use Swiss yen. Now this one is back to being very close to Euro USD, just slightly higher. If we switch it again and do GBP, JPY, also very close. If we do NZD JPY is also very close. So that's what I was saying before, that like you can use it. You just need to be aware that it's not going to be exactly accurate, but you can still use those calculations. If you want to always use the calculator, you can. If you want to always do it manually, you could. The ones that you need to watch out for are pairs that are indices. So like US 30, SPX 500, NAS 100. You can't use this position size calculator for those because every broker has a different counting strategy for their pips on those indices. So the Forex calculators don't work for them. But yeah, so this is the calculator that I prefer to use. You can see this one again. So Euro AUD, now you can use a larger lot size again. So it varies slightly, but you're generally in the right ballpark, even if you calculate it manually the way that we were before. So that's it for today. This is just a short video to show you how you can manually calculate your position size or your lot sizes for your trade so that you're making sure you're using proper risk management on those trades. And yeah, so that's it for today. Thanks. We'll see you next time and we'll catch you on the pip side.